Hey everyone, this is Michael Slauson. Welcome to our webinar series. Today we're going to be learning more about growing recurring revenue businesses with less dilution through debt and non-dilutive financing. I've assembled an illustrious panel of great people with great insights into this topic. And before we do introductions, I just wanted to set some context for everyone why I thought this would be a good topic for us to discuss today. And it really boils down to the choices that entrepreneurs make. And one thing that we've observed is that about half of entrepreneurs who raise equity regret doing so when debt was available to them, at least retrospectively. We also observe a really interesting trend in the financing of private companies, which is that companies 10 years ago, technology companies raised about $5 billion of debt. This is private companies. And last year they raised $25 billion. So five-fold increase in the last 10 years. And obviously that's still, relatively speaking, a drop in the bucket compared to the total world, the totality of financing for companies in the technology space. But maybe it's a good fit for your business. We're here to talk today about how to know if debt or non-dilutive financing is a good fit, when to raise, and what you should know about the process. So I want to spend a few minutes just introducing our panelists, starting with myself. I'm Michael Slauson. I lead growth initiatives here at Hum Capital. Hum Capital is a funding platform. We connect companies with pools of capital between $1 to $50 million plus. And we have a strong focus on debt. We have a few hundred institutional investors, lenders on our platform. We have a founder with experience raising debt, Nikunj Mehta. Nikunj is the CEO and founder of Falconry. It's a Forbes AI 50 company. They provide industrial AI operating systems for reliability and quality excellence. And then we have two lenders with us. We have Ed Wu. Ed is managing director at Bastion Management, private credit fund. They specialize in lending to financial contracts, including recurring revenue and contract businesses. And then we have Maytal Shainberg, and Maytal began her career focused on venture capital-backed digital advertising startups. She joined the fintech startup FastPay in 2015, in which she built their sales strategy and focused on enterprise clients. And today she leads East West Bank's new media lending group. And so she has great experience on both the bank and non-bank financing side for debt for companies. And to the audience, we have a Q&A up and running, so feel free to send your questions along. If they fit into the ongoing conversation, we can try to address them in real time. We also have some time set aside at the end, hopefully a good chunk for an open Q&A. So looking forward to hearing from you. And yeah, so to get started, I want to pose a question to any and all of my panelists here, which is why are we talking about debt? What do you think has made debt become more popular for recurring revenue businesses in particular? What's changed compared to 5 or 10 years ago that makes it more interesting? I'll let anyone jump in here.
Yeah, maybe I can provide a perspective from an entrepreneur's viewpoint. So two things. One, just as much as capital is available in plenty in the venture investor space, there's just a lot of capital available in the non-traditional venture capital form. At the end of the day, the need for capital has gone down substantially over the last, say, 15 years, 10 years. But one thing that has been particularly relevant for AI companies is that they have had to tack on one more stage in their life cycle compared to the typical SaaS companies. And that is the match between the AI model and the market that they are serving. When it comes to a typical SaaS company, that's not the case. And so how do you finance growth to that stage, the early stage of a company, is a somewhat uncharted territory. And we've seen plenty of examples, famous companies like X.AI, where they spent $65 million of capital before they reached product market fit. These examples illustrate to us the fact that while there may be plenty of capital in a world of innovation that AI mostly is, it can be hugely dilutive to entrepreneurs, which eliminates the incentive for them to innovate. And so when I look at it from an entrepreneur's perspective, I need to match the type of capital we use to the type of innovation we need to perform and to the incentives for all the stakeholders involved in the process. And from that perspective, non-dilutive financing, I would say, not debt so much, has become more attractive. Both the availability, but also the need for capital in those AI organizations.
That's great. Ed, did you have some thoughts? I saw you go off mute.
Oh, yeah, sure. So, it's interesting. The whole nature of credit is, or debt, which is also called credit, is, even the word credit is, does a company or an asset, quote unquote, deserve credit for something? In throughout sort of the nature of financial markets, there tended to need to be, some reason for capital to be extended to a company or an asset with some reasonable certainty of getting paid back, because the nature of credit is such that your upside, your coupon is fixed, and you don't really participate in any of the upside beyond that because you don't own anything. As opposed, it can be a very sort of aligned instrument compared with equity when things are going well, but when things are not going well, it can be misaligned, versus the owners. With the nature of tech, I think or sort of tech-enabled businesses, whether AI, SaaS businesses, we're talking about recurring contractual revenues, which have in many cases are tech-enabled. I mean, I think early on, I think the initial reaction was tech by nature was a very much of a growth story, which meant equity, as opposed to a fixed upside, meaning, which is more akin to credit. But I think what you're seeing in the market now is, number one, a lot of capital, a lot of debt capital chasing opportunities, and two is, kind of the nature of business models, which can accommodate debt or non-dilutive instruments and the paying back of that capital through things like recurring revenue contracts and other. I mean, we lend to all sorts of financial contracts, so this is one subsegment, but there's all sorts of other things which we can talk about later as well.
Awesome. Maytal, I'd love it if you could give us maybe not the 101, but the 102 of like, what are the flavors of non-dilutive and debt financing that we see recurring revenue businesses take?
In my experience, I see one of two things happening. Well, I should say one of three things. The first is you have, specific sort of factoring companies that focus solely on SaaS type companies. The issue there is capital is really expensive. The second type is just your term lender, right? So your mezz debt, junior capital guy, he'll come in and write you a check, take some warrants, again, a pretty high coupon. And then the third is you'll see your traditional bank financing, which, it needs to fit into somewhat of a box in order to be, I don't know, credit worthy, I suppose, right? Like I'll personally lend 3 to 5 times monthly recurring or annual recurring. But if you have 2 customers, then that's not necessarily something going to be able to get across the credit landscape, right? So I think it was Ed who said this, right? I think part of it is we need to determine, like, are you in the growth phase, in which case it does make sense to take on equity and or sort of alternative financing that can kind of expedite your growth, or have you kind of proven your concept and then you're more suitable for bank financing?
Interesting. Yeah. I mean, something that we observe, many lenders look to the cap table actually to decide if a company is creditworthy. I think that as we see more data being transferred to the cloud for private companies and that data being exposed and accessible to lenders, that there's an increasing level of comfort with lending, even if the company is not venture backed. But yeah, something I observed with banks is that ordinarily, who's invested previously and the diligence and the trustworthiness of their diligence plays into creditworthiness for their.
Yeah. Although, I mean, let me just counter that for a second, because I'm not really sure who's on this, but to the extent that this might be useful information for operators who might be on the call listening in, there are definitely certain banks that care more than others. So a lot of banks feel that way and look to the cap table mainly because they're banking the venture firm that's backing your company, right? So that's what sort of Silicon Valley Bank is known for, right? They can get comfortable and underwrite quote unquote riskier credits because they're also banking the parent who's giving you money. My personal view on that, I never look at that because they could cut you off at any second, right? And so to me, it's not a really good assessment of credit and a risk mitigant to something like that. To me, it's all about stickiness when we're talking about SaaS companies, and bare bones, if I have to turn off the lights off tomorrow, how much revenue can you actually produce? Because that's what really matters, right? Like how recurring, how sticky is the revenue you're creating, and how much of it is tech versus you're hired a bunch of SDRs and you've given everyone a free 1 month trial. And then after a month, they kind of fall off.
Yeah, stickiness definitely matters. If you think about your customer as an asset, how long is it going to last? And if it's going to last for years, then you can much more easily lend against that. Okay, so something I'd love to hear from Nikunj, since you raised debt before, but also Maytal and Ed, feel free to chime in. What would you say to someone who is raising debt for the very first time? And how does that experience differ compared to raising equity?
Yeah, my first experience raising debt was before we were venture backed. And I used to bank with traditional commercial bankers like Chase. And back then, I had no access to either VC or any other venture source of debt. And back then, it was just small business lending. And it was a painful process because it was probably like a 60-page documentation, even though it was US government backed and personally underwritten by myself. It was painful because it was not so much a question of whether the debt was too much. I mean, we had certain income, so it was primarily being issued against that. Over time, though, as we transitioned into venture capital backing and moved from traditional commercial banks to more venture capital friendly banking environment, I started to realize that the needs for us in terms of issuing debt, et cetera, would allow us access to a greater amount of non-dilutive financing. But very quickly realized that covenants, various restrictions, especially for companies like us that have a huge export component, that do a lot of business with the government, and that are also going through that product market fit exercise. We went through that over the course of the last few years, mean that you might be able to extract maybe 10% of the credit that you've actually been given access to. And it can throw off all of the planning that you had in mind. And you don't really have a sense of that because it is somewhat opaque and you have to submit again and again for review, whatever are your receivables. So, my experience with that taught me that you need something that is more transparent, even if it's smaller. More importantly, you need those covenants to be less restrictive because, as an entrepreneur, naturally you want that. But more importantly, when we went through the pandemic, I'm pretty sure that banks that had some very strict criteria struggled to keep their customers when there was access to other forms of financing available out there. I'm talking about a little more than a year ago. So I know long-winded way of responding to you, Michael, but I would highly encourage those who are generating recurring revenue to first look at non-dilutive financing well before they look at venture debt.
Ed?
Yeah, yeah, I agree with a lot of that. And, there's, whether you call it venture debt or non-dilutive financing, revenue-based financing, in some cases, advancing, merchant contract advances, whatever. It's credit in some form. It doesn't always have a stated maturity or stated coupon, but it's some form of advancing of capital. But I think one big underrated aspect, I think, in the credit markets is people tend to think of credit as being much more commodity-like than it really is, especially for early stage companies where the credit is being advanced against assets, some type of asset-backed credit. Let's say it's revenue-based financing. I think it's important to find the right lender or capital provider. Not always quite as important as the equity investor, because equities are actually owners and they sit on your board sometimes, and they have affirmative controls, not just negative controls. But capital, sometimes people think of credit as, okay, let's just get 10 term sheets and the lowest pricing wins. Mm-hmm. And the thing about that, especially in a market like this, is capital always comes attached to people. Mm-hmm. Period, right? It just is, as it stands right now. Maybe someday there won't be human interaction with capital, but there is now. And the people behind that capital are going to act a certain way, and they will have a track record of history of how they have acted with their borrowers in times of stress. And we've actually told some of our borrowers on deals that we're working on, hey, listen, talk to some of our borrowers as to how we worked together with them during COVID or even before. And because when you enter a borrowing relationship, there's definitely some lenders who want that one-time transactional nature, as opposed to some lenders who want to build a relationship, and especially in these asset-intensive businesses, be a financing source for the long term. And that could sometimes mean starting off as in a senior position, and sometimes subsequently subordinating to a more junior position. We've actually done it several times where we go into the equity, and where the equity has gone public, and we benefited from lower cost leverage as the company got bank financing. So I just think it's just underrated to sort of really actually know who your prospective lender is.
So how do you diligence that? Like, are we talking going and searching Google reviews, or is there a way that you would expect a savvy?
Yeah, you would. Yeah, there's no Yelp. There's no Yelp, unfortunately, for lenders.
Ratemylender.com.
Ratemylender.com. I don't know. What we do is we actually talk to people that we're doing term sheets with. We will give them a few numbers of our prior or current borrowers and say, talk to these guys and ask them how we work with them during their last covenant amendment.
Interesting. Yeah, and I'm curious, Nikunj, how are you going and trying to get a sense and feel for different lenders, besides how big their smile is? How do you figure that out? You're on mute.
I didn't know that the question would come to me, but I was listening to Metal and Ed closely there. Yeah, there isn't a way to rank one lender against another. That's obvious. You do have to build a little bit of chemistry with the associate or the lender executive that you're working with. But I think what is most important in my mind is how well do you think your lender is able to understand your business? Like, do they have a sense of your business that's even a representative fraction of your own? Or do they think it's a different kind of business than what you think it is? Because I think that is where trouble really starts. And if they appreciate some of the risks that you are aware of, and they see some of the potential you have, then at least the lender is seeking to understand your business. And that's where I think Ed's point, it's not commodity. People who understand you are not a commodity. The second thing that reflects a good lender is in the way their term sheets are structured and how clean or not it is. If it is loaded with terms that you have to negotiate and you have to basically chip away at in the negotiation process, it's not good for you. It's just a war of attrition. So that is another sign. And I would say that the third sign is how much do they help you structure your borrowing in a way that actually meets your need, especially we've referred to recurring revenue. So you know you're going to have recurring sources of income. Do you need to load up all that money up front? Or is that lender savvy enough to say, hey, I'm approving you for a certain amount. You don't have to borrow it all up front. You'll actually be able to draw on it over time. Now, as a borrower, I'm always worried, what if their circumstances changed and they decide that the line is no longer valid to what it was before? I mean, those kinds of surprises I don't want to have to deal with. But yeah, ultimately it is borrowing and surprises can happen. But the flexibility and how they approach it tells you a little bit about, are they willing to think about your business, or do they need to just ship this money out of their door as soon as possible? So these are just some qualitative indicators. I don't know that this is exhaustive, but we did use this in our selection process.
That's great. So on the other side of the coin, Maytal, you've worked with a lot of companies. I'm curious from a metrics perspective. Obviously, no two companies are the same, but from a metrics perspective, what matters, and then qualitatively, or something you can't find necessarily in the balance sheet or the P&L of the company. What are you looking for when you're trying to decide if a company is worthy of a loan?
Well, just in response to the last couple of comments, I feel like I need to do a tips and tricks when we got a tips and tricks, like here's all things you need to know about Zoom. Nikunj, I feel for you and I hear you, and I think that you're 100% right. And folks should know that if a term sheet's not a collaborative process, they're not the right lender for you. Like, there should be zero surprises, and there really shouldn't be any negotiations once you receive a term sheet. Maybe one thing here and there, okay, fine. But if it's like brand new, shocking to you, that should really just never happen, in my opinion. Another thing I would just caution folks who are out in the finance getting debt or thinking about getting debt is one is a tip and one is a trick. So my tip for you is, when you have seasonality, which a lot of folks do, especially in this space, there's no reason why your line shouldn't fluctuate to accommodate that and then fluctuate back down. So a lot of times what you'll see, at least in bank financing, is a concept of something called an unused line fee, right? So that's me saying, hey, you're eligible for $10 million. I'm committing that capital to you. So that costs me, Maytal Shainberg, money. So if you're not going to use it, then I'm going to charge you a small fee. If, however, the notion is like, I have $5 million of AR at all times, but for Q4, it's like whatever I'm doing around Thanksgiving, Christmas time, New Year's completely expands, then how do I, as an operator, know that my bank's going to be there for me, right? All of a sudden you've overextended yourself, and then you can't produce more in order to fulfill orders, et cetera. If I'm an operator, I want my banker to know that up front, so that I, as the banker in the term sheet, can say like, great, I'm going to put a seasonal accordion. By the way, that's like super common, something a lot of people don't know you can do it. Unfortunately, a lot of bankers don't think ahead and sort of ask for it, because I come more from, like, I was an operator before I was a banker. So I know working capital needs and crunch times, and it's just a lot more difficult, and I shouldn't have to worry about that. So I kind of like ask my borrowers of like what they'll need, but just know, I feel like for those who are looking for debt, just know that those types of things do exist. On the flip side, also, if you're looking for term debt, there's a concept called the delayed draw. So like, again, I can ask for $15 million, 5 of it's up front, $10 million is an acquisition I know I'm making in 6 months from now. So it's a delayed draw. So I'm not paying interest for money I'm not actually borrowing. So that I just wanted to sort of like make that point. In terms of like what I look for, honestly, a lot of it just has to do with, like, where's your AR? Are you a normal person with a normal company, right? Do you have a story? Have you been around? Have you proven out your thought? Like, do you have more than a handful of customers? And then where's the company going, right? Like a lot of it is as small as like $1 million line, but then I had a company that actually had government receivables that I was able to lend to, because there's actually a way to do it. You just need to work a little harder, and a lot of people just don't like working a little harder. That'll go up to $50 million. So I'll go really small if I believe there's a growth story there. But I think typically a bank would want to see your revenue somewhere in the $5 to $10 million range at least. Otherwise, you may be a little bit too early for a bank.
Got it. So you mentioned something about term sheets and negotiations. I'm curious how much negotiation are you expecting once the term sheet has been issued versus kind of in the preliminary conversations leading up to the term sheet versus post term sheet when you're kind of in the final diligence?
Yeah, I mean, frankly, I haven't been at East West Bank for a long time. I've been here only a year and a half, but I've done like 24 deals so far. And there's only been one time where I actually negotiated a term sheet. So at least the way I do business, and it's honestly, I think everyone should do this business, because think about it from an operator's perspective. Okay. You're the CFO, you get a term sheet, you have to present it to the CEO and the board. There shouldn't be any surprises, right? Like if you're a CFO and all of a sudden your CEO is asking you to go back to the banker and do X, Y, and Z, then you haven't really done your job, in my opinion. The only time there's real negotiations is when it's a super competitive process, right? And so you're going to like fight about half a point here or a quarter point here, or get rid of the unused line fee or things like that. By the way, tips and tricks, like things they won't tell you, but you should know. A closing line could be like a commitment fee could be negotiated, a termination fee can be negotiated, an unused line fee could be negotiated. These are all things that I think sometimes folks don't realize is a little song and dance. So there is an element of push and pull, but you shouldn't, not the banker nor the borrower should feel like they're getting retreated post-term sheet, in my opinion. So it's just not a practice I like to do.
That's interesting. It goes back to Ed's point of no two lender. Lending is less of a commoditized business than you might think. And I'm curious, Ed, on the non-bank side, do you observe the same kind of, here's the term sheet, we feel good about it, and then there's very little variation from that point? Or do you expect or often see negotiations evolve around the preliminary terms that you propose to a company?
Yeah, I mean, I think there's negotiation that I don't know if it's formal negotiations or just, a feeling out process throughout the early part of the diligence, where you both kind of get a sense for what the lender needs to protect themselves if the business goes sideways, and what the company needs in terms of amount of proceeds to grow and the terms on which they need that capital, and can the lender meet that need, meet those terms. There's definitely, you start off with this sort of feeling out process, and it is a negotiation in the sense that it's iterative and it's a constant dialogue. But I think for us, it happens. And I think part of it is, as I was saying, there's, because we are a non-bank lender, the companies that we're going to work with are going to tend to be less mature. than I'm sure East West Bank. And so for almost every company that we work with, it's almost like we are the first institutional capital there, where we're kind of like a credit facility on training wheels. A lot of times they've cobbled together equity and sometimes subordinated notes from friends and family or high net worth individuals or other folks that are non-institutional, and they're not used to having to report a borrowing base or having monthly servicer reports or all sorts of different things that are necessary to keep track of the assets and the status of the business on a monthly basis and how much money should be extended on a revolving credit basis. So, for us, we're going to be a little bit earlier stage than East West Bank. And as a result, the negotiation, there's negotiation throughout the process. But the one thing I would agree on is by the time you get a signed term sheet, there shouldn't be any surprises. I would say for us, there's negotiation up until the point of a signed term sheet. And then after that, we basically strive to only sign a term sheet where we know we're going to close on the terms at which the term sheet is signed.
It's interesting to see how different parts of the credit markets operate, sometimes in rhyme with each other, and in other ways there's differences in the experience that founders can expect to have, and CFOs. So we're going to transition into a Q&A period for a couple of minutes. Before we do that, I would love to get like the last sort of advice that you guys would have. One thing we didn't talk about is when do you raise debt or non-dilutive financing? At what point in the stage of a company? How can you know that the timing is right? I'd love to get some thoughts on that.
Well, I used to listen to some VCs earlier who used to say that the moment you raise a round, you want to secure a venture debt provider. We didn't quite do that because I wasn't comfortable with the additional process that I would have to go through at the time. What I've learned in the years since is that you want to secure some additional financing to give yourself flexibility to push up the growth ladder a little further than where your equity will allow you to, so that you can fully express the potential of the growth trajectory you are on, and that you can get to a point where there is adequate evidence that you can now lower your cost of financing by turning it into equity. And so it's basically this constant cost of financing management that should inform. Now, it's not straightforward, perhaps, but you also want to do that when you have large customers, and this is my own perspective, but when you have large customers and you know that there is a way to grow their ARR, and you can do that without having to take on additional equity because you know what they need, you know how to fulfill on it, and you just need capital for that. So when that becomes relatively clear, financing methods other than venture capital might be a good way to grow. Venture capital is probably better for sales and marketing growth that can be very risky for market expansion, but for customer expansion, the alternative financing, I think, is better. So you need to know which mode of growth you are in.
Yeah, just to piggyback off of that, it's interesting to hear you talk about customer expansion as a good use case. I would actually say sales and marketing is a great use case for non-dilutive financing, so long as you profitably acquire customers. If you have good unit economics, and meaning you put in $1 into your sales and marketing engine, and you can consistently on a median basis get out $1.50 or plus, $2, $4. And it's not just that you did that 1 month, but you do that every month, and you've done that for the last 12 months or the last 18 months. At that point, you can grow faster than your own cash flows will let you by leveraging the fact that you have really strong customer acquisition, profitable customer acquisition. But if you're trying to go into the, investing in R&D or product expansion, things that are more risky, it's probably imprudent to finance that with debt unless you have a lot of cash in the bank to support, kind of your whole operational program. Ed, I saw, or Maytal, you came off mute.
Yeah, no, I was going to agree with exactly what you said. The one piece of advice I'm going to actually steal from Ed, because I think it's a brilliant piece of advice, is just to ask for reference. Like the same way alternative financiers or banks will always ask you for references. There's no reason why you shouldn't make sure that you too can get references back on who you're getting in bed with, because I think as long as everyone appreciates that it's a relationship as opposed to a transaction, then you're more likely going to have a much more successful experience with whomever it is you choose to finance your company with.
Ed, any thoughts here?
Let's see. One thing that occurs to me, we are in a pretty exuberant credit market, and there's a lot of debt capital available. I think there sometimes is a temptation on the part of borrowers to sort of get as much debt as possible sometimes on a non-dilutive basis. And, sometimes that debt is available and there's lenders, particularly, I don't know, I think Maytal can speak for the banks, which are obviously regulated, and there's a deposit base, there's access to Fed reserves, there's a little bit more conservatism. But on the non-bank side, because they're unregulated, for better or for worse, as a credit fund, you can kind of do whatever you want, and there's no regulator looking over your shoulder. That can sometimes lead to some very, very aggressive early stage pricing. And it's almost like sometimes those deals for borrowers, you might get 100% advance rate at an incredibly low pricing. And sometimes those deals are really, really good, and they're worth taking. What the danger, I think the hidden danger that happened through COVID and could continue to happen, is some of those lenders, those non-bank lenders that gave out incredibly aggressive terms, gave out those term sheets or closed those loan docs with many, many, many borrowers. And what happened was they gave out really aggressive terms to all these borrowers, and then one or two of the borrowers went sideways and their fund blew up because of it. And then what happened when their fund blew up is they could no longer fulfill their lending obligations to their remaining borrowers, the other borrowers, the borrowers that went sideways. And so because you're not a bank, you don't have a deposit base, and you don't have reserves to set aside, you're a fund, you're a non-bank credit fund. There were a number of high profile, pretty large multi-billion-dollar credit funds that blew up. And they basically defaulted on their remaining lender obligations that they had with other borrowers. And so their borrowers could no longer access the capital that they supposedly had committed from these lending funds, because these lending funds gave out very, very aggressive terms. And so it's a tricky thing, because on the one hand, you want to get as much as possible on the best terms possible. But if a lender is giving out these very aggressive terms to everyone, there is some chance that lender will go out of business and will no longer be around in a couple of years when you need to access more capital. And that could be a problem for you. And that's kind of it's a nuance that, may or may not present itself, but it did present itself during COVID in a couple of high profile instances, and it could present itself going forward.
Thank you for those perspectives. So we have a couple of questions. I'd love to spend the last 15 minutes ticking off some of these if we can. One, I think it's a great question just to kind of level set. So when we say debt versus venture debt, what's the difference? Like, why is there a word for called venture debt, and what does it mean?
Do you want me to take that?
Yeah, that'd be great.
So venture debt is a term that gets thrown around a lot. It's typically used for earlier stage companies, but it could be mid-stage companies as well. Venture debt just typically means I'm going to throw a ton of cash at you. It's not really tied to anything except for I think you're going to continue to raise and then eventually get acquired for some large sum. And I'm going to take warrants, which is a version of equity, and hope that I get paid heavily for it. It's usually very covenant light, if at all. And for those that are interested in it, personally, I think Bridge Bank's the most competitive when it comes to it. So we should them. East West Bank were in it, but I'm definitely, as an example, I just lost a deal to somebody. Not to somebody, I lost a deal to Bridge Bank. I offered the guy $10 million. They offered $20 million. I don't know how the hell they got to $20 million, but I was like, if that's what you want, like, I can't, I'm not going to double it. That's just crazy to me. Debt in the firm I think we're talking about is more of just like your typical working capital revolver. So that's usually tied to some sort of asset, whether that's inventory or your accounts receivables. And it's usually leveraged by a multiple of your recurring revenue, whether that be that monthly, quarterly, or annually.
That's great. You're my Investopedia for the day. Thank you. Another question. I think this is really from the founder's perspective. When a company raises debt, can founders take money off the table like they can with an equity raise? Ed or Maytal, could you talk about like the concept of a dividend recap? Yeah.
We don't love it. We especially don't love it if you're EBITDA negative. I've seen people try to do it when they're not even EBITDA positive yet. So if you're negative, try not to bring that up. I would say wait until you've secured a term sheet and then politely bring it up. And then typically, I'm okay with it in general. So long as the use of proceeds for the debt is not to pay you out personally. I want to make sure that you still have skin in the game. Ed, you're nodding your head. I feel like you've probably been hit with the same question multiple times and you're like, it's not the right time.
It's a standard covenant that we have that, to your point about EBITDA positive companies or EBITDA negative companies, that we typically will allow dividends, but only a certain percentage of the profitable cash flow that gets generated by the company. And if it's negative, it's sort of like, you're taking cash out, company's still not generating cash flow, it's not self-sustaining, and
Not a good look.
then as a lender, you're funding the takeout. So
The yacht in Miami.
How do you monitor that?
Well, it's typically a covenant, right? So when you sign a legal documentation, it says that that's something you're going to have to get consent for. So that's sort of how it's monitored. But yeah, I mean, can someone just start take money? Someone can commit fraud for sure and start wiring themselves money on an offshore account. That has happened. But I would not recommend it because you will go to jail. Well.
I once worked with a company that asked me the question, how will we fail? How could we fail diligence? And I said, well, if you're committing fraud, that would cause you to fail diligence. And then he said, did I mention we have a bank account in Bangladesh that I didn't bring up yet? And that ended that conversation very quickly.
Yeah.
Okay, so for Nikunj, this question is, how do I find the right lender for me and my business? I know about commercial banks, but how do I find other options I don't know about?
That was a question I had at the beginning of the year, and I didn't really know how to go about it. I worked with Hum at that time, and Blair sort of suggested that the profile of our business was suitable to being financed in this way. Of course, if you are a founder or a CEO of an early stage company, LinkedIn has made it possible for those non-banking finance organizations to find you. So they can find you. I haven't been able to confide in any of them, perhaps. And so I prefer going through somebody who has some credibility and scruples. And so I choose to work with somebody like a Hum Capital or a Pipe to actually connect to those non-traditional lenders.
Yeah, there is a question actually in the chat on what's the difference between Pipe and Hum and CapChase, and it feels a little shamelessly self-promotional, but I will quickly explain that Hum Capital is a marketplace. So we have, for instance, CapChase is in our marketplace, and we have a few hundred different institutional lenders. We are not a provider of capital, at least not at the current moment. We are basically like a kayak.com for raising financing. And so we really do try to provide an extremely unbiased view of the market and help companies figure out where they should fit, which pools of capital they should be reaching out to. Whereas Pipe specializes in revenue-based financing. CapChase is basically a cousin of Pipe, just slightly different terms and pricing. So whoever asked that question, hopefully that clarifies things. Another question that I'm super curious about: have you guys ever seen boards and founders disagree about whether debt is a good idea? And how does that usually go? Obviously, if they've started talking to you, it's more than likely they've decided it's a good idea. But I would love some thoughts on like, what are the dynamics there between boards and the operators or the exec team?
Yeah, I've seen it go both ways. I've seen board members say, hey, you should go through this venture debt process and avail yourself of that line. And I've gone through it only to realize that, they just gave you boilerplate advice. And then at other times, I have, as example, worked through the process this year to find something that was surprising to board members. And it was a very smooth conversation, but they weren't expecting it at that time. And they learned something from me in the process. So I'd say that in general, boards should be looking at what's the risk to the company and what's the way to maximize the enterprise value. As long as they're doing that, I think these conversations can be had quite comfortably between those sides.
Additional thoughts on this one? We can move on to the next one.
I mean, I've seen it both ways. I mean, like I've seen it firsthand at the startups that I worked at before being on the bank side. So yeah, I've seen it for like, especially around acquisitions, right? Do you raise equity to fund an acquisition, or do you raise debt to fund an acquisition? And there's a lot of people who feel very differently about it. Look, I think at the end of the day, to me, alternative financing is always the cheaper route to go if you truly believe that your equity is worth something, right? So there are definitely life cycles within a startup, and there is definitely a point in time where you may or may not come to a realization of like, this is not a unicorn and I have to get a little more realistic, in which case you don't mind taking equity because you don't necessarily believe in the company as much as you once did, right? There was a point where I worked at a mobile publishing company, and like AOL was going to buy us before Yahoo bought AOL. And then they decided not to. And then we were like, should we raise a B round or should we raise debt? And we decided to raise a B round because frankly, we knew we didn't have a unicorn anymore, right? So look, I think a lot of it has to do with who your board is comprised of. A lot of people have different motivations, right? So you as a founder need to be a little bit realistic about what your personal motivations are, what's best for your company, and a little bit realistic about who's on your board and what their motivations may or may not be.
Yeah, I think that there's it's when I put like my corporate finance 101 hat on, and I think about the fact that companies have just come to believe that raising venture capital is this sexy thing to do, and having these new lead investors each round is really cool and gets you access, and obviously equity capital plays an important role in financing companies in both the United States and the global economy. But it doesn't really make sense that, you know, you would be willing to sacrifice so much dilution if you really believed in your company. And then on the other side, you have bootstrapping, which is when you take no money from anyone and you just grow through your own cash flows. I think there's a middle ground, and I would call it debt strapping, which is where you grow with debt and, you know, you continue to preserve the value of your equity because you can profitably acquire customers. So we'll see if that term ever catches on. And then just real quick, would love to hear Maytal and Ed in the last minute or two. What pushed you towards debt versus equity? You know, you know your way around balance sheets, you know your way around financing companies. What draws you towards the credit side of the equation?
It's a great question. I'm on, I don't know. I think I'm on both sides of the equation. I mean, I personally invest, so that's sort of my equity hat. I think that I see a lot more interesting companies from where I'm at because I see it throughout the entire growth cycle. And I think that if I was just at a VC, I'd be looking at mainly startups and would have to start from scratch. So it's a selfishly personal reason. I don't have a good answer for that one.
Ed, what about you?
It's hard to say, you know. I think what I was initially attracted to when I first got into financing of financial assets was just sort of the assets themselves, you know, all these types of assets that we finance, whether they're recurring revenue businesses, SaaS businesses, music royalties or content royalties, litigation claims, all these sorts of oddball niche assets. And it just turned out that the way to finance them was through credit or debt instruments. So that's kind of how I ended up, you know, in the last sort of 10 years financing these types of assets.
Yeah, I would say for me, it's about cost of capital and, you know, helping founders to preserve ownership is what really draws me to it. Because if you have if your recurring revenue business is financeable by debt, then at least part of your balance sheet should have debt. All else equal. I mean, it's hard to say that as a general rule. Well, thank you everyone for joining our webinar. Hopefully you found it informative, educational, and entertaining. This is being recorded. We'll be sure to send out a copy of the transcript and the video as well. And we look forward to having you at future events. I want to thank our panelists, Nikunj, Ed, and Maytal for joining us. It was great having you. Really a great variety and breadth and depth of opinions and perspectives. So appreciate all of you joining me.
Thanks, Michael. Thank you, everyone.
Hi, guys.